not that one.
Then it's what? What are we going to talk about?
Just whack this episode. Whack Gao Gao Lat. Now it's show off
Okay,
time.
so never
So
mind. We take a start.
Meituan, you asked me what's the cost basis. Yeah, cost basis 294.
Oh, so
This one
Meituan
is
is
not
actually
updated lah. This one
yeah
maybe they got some delay lah. Eh?
yeah. So Meituan is down 10% now in the Hong Kong market. So Bunti, that's a 66% shave off from your cost price.
Yes.
So you're down 66% on this position.
Yep.
Now I'll provide some comments on their most recent earnings. I can pull out the numbers for you lah.
It's okay.
Yeah.
I think yesterday I roughly looking at the results. So okay, usually they will do compare like this quarter versus the quarter of like 1 year ago, right? So results definitely look good if you compare to last year. But actually, if you look at their growth rate, actually they slowed down a bit. Now it's about 20% plus. And then earnings wise, I think their margin also improved compared to last year, but it's kind of like stagnating already. They can't even achieve let's say like a 10% net margin. So if you ask me, like compared to the outlook that I had when I bought the stocks, definitely it didn't perform that well. Okay, I haven't done like deep research into this company over the past, let's say one year or so, right? But my guess is that whatever new regulations coming out from China, I think really have some impact to their fundamentals now. So at least it hurt their growth, and that's one thing. On the other thing, in terms of the business line, there are the core business that is like the local consumer, right? That's earning money, but there's still a lot of all these new initiatives. I don't know what they keep doing that, still losing money. Talking about a bit on the reflection, I would say this one to me, right, is like my pick few years back, and I admit that this is a mistake that I got into this company, and then the result hasn't performing well, and then you can attribute this to like regulation risk, country risk, or whatever. I don't think that's important. The important thing is that if we look at the fundamentals, it's really not as strong as I expected, and even if you expect this kind of fundamentals to continue, right, even at today's price, right, it's still not cheap lah. So that's why I stopped putting money into this company for a long time already. And for now, it's just like, continue monitoring and likely just treat it as like completely like, written off lah for this company. And in terms of percentage wise, it's getting smaller and smaller of my total portfolio lah. So it's not that damaging to me lah. It's like how much money that I put in, right? The most that I can lose is 100% of those money. And really, I lost 100% of it. So and I'm fine with that.
What's the thought process though? Why is it fine with that? Why not just sell it and buy more Nvidia or something that you have more conviction in?
Yeah, I think this one is like, comes to stock investing, right? You can compare, let's say, stocks versus bonds, okay? Bonds, right? Let's say you someone like you buy a bonds, so the company owe you money, right? The best upside that you can have is that the money get returned to you. And then the worst downside is that you go bankrupt, you lose all your money. But when it comes to stocks, right, is that the most you can lose is your capital, like 100% buy up for that particular investment, right? But the maximum it can like 2x, 3x, 5x from there, right? If you hold long enough, 10x is also possible. So I think the strategy is that you have to like put money in different companies, and then those that are doing well, let them run, and those that will deteriorate, just let them die lah. So on portfolio basis, it's fine one. Yeah. So this is not like me talking nonsense. This is like proven kind of investment strategy, and this is very clear. Especially you talk about like all this startup investing, like all those VC investing, right? That's the principle that they're doing. They are not like putting all their money into like 2 or 3 companies and then hope that will what big. Actually, no. They just sprinkle the money around and then just hope for one company's that 100x, right? So they make out all their monies lah. So I would say for stock investing, usually this is the like this is one way to do it now.
Not really Meituan, but so I was watching this Joseph Carlson video recently. He said that Magnificent Seven was what powering the whole S&P 500 return for this year. Then he said, oh, it's actually not true, because if you look at the year-to-date returns for the S&P 500 companies, it's actually not just the Magnificent Seven who have gave a lot of returns. Year-to-date return for S&P 500 is about almost 20%. So one quarter of S&P 500 holdings actually able to outperform the S&P 500. I think the average is about 30 to 40% of the companies that can actually outperform the market, basically.
And that is the idea that you can't beat the market. I'm sure you've been told that a time or two since you started investing. Every investor is told that by many people. There's a lot of people out there, media outlets, money managers, different people that are bogleheads, a whole segment of the market that has convinced themselves, and they're trying to convince others, that it is virtually impossible to beat the market. Their claim is that as an individual investor, if you're picking out individual companies, creating your own portfolio, you really can't outperform the S&P 500. If you do outperform it for a month or a year or 2 years, well, you basically got lucky, or you took on a lot more risk and you just simply got lucky. And the people that have beat the market, the outliers, the pros, people like, well, Warren Buffett, they were just super lucky. They're 1 in a million. They're one of a kind. And you're not Warren Buffett. So don't even try to be Warren Buffett. Don't try to pick individual stocks. But what I reject is their notion, their idea that investing in individual companies is akin to gambling, that nobody can realistically outperform the market, and the idea that if you do so, you're simply just lucky. That paints a very grim picture for individual investors, and I think it's wrong. I think it's an inaccurate picture. One of the biggest arguments that they use to discourage individual investing is the idea or concept that only a couple companies are responsible for the majority of returns in the stock market. And unless you pick those few companies by either skill or luck, you're going to be left behind. Only 7 companies that are driving this market rally. Now, if we look at the article, we have the 7 companies right here. It is, of course, the Magnificent 7. Do we really have the skills to select only a handful of companies that are going to outperform? The odds are that we're going to select some of the other 493 companies. We're going to underperform. Looking at this is extremely discouraging as an investor. You can come away with the belief that these 493 companies are basically duds. They're underperforming, and you have to have selected only a few companies. Let's go ahead and take a look at the actual data here. First of all, we can start with just this year. We'll look at the S&P 500's performance this year. You'll notice that year to date, it's up 19.45%. So that is the market's performance. This is the haystack's performance. Let's go ahead and take a look at the needles in this haystack. Right here, we have the S&P 500 component returns year to date. So this is a breakdown of every individual stock within the index and their individual returns year to date. Let's go ahead and take a look here. We have NVIDIA Corp with a 230% performance. Did that beat 19%? Yes, it did. So we have one that beat the S&P 500. This is one needle in the haystack. Then we have Meta Platforms with 178%. That's another needle. We have Accenture, 149%. We have Royal Caribbean, the cruise line, that one's another needle. We have Polt Group, 93% returns so far this year. Yet another needle. We have 92% returns with Palo Alto Network. Tesla, that's yet another needle that's outperformed the haystack this year, 91%. But we can keep going. We have Synopsys, Broadcom, Salesforce, Cadence, Copart, Intel, Netflix, Eli Lilly, Chipotle, Microsoft, Alphabet, Booking Holding, all above 50% returns this year. We get up to company 120 and we're still above the S&P 500. Now remember, the S&P 500's returns year to date is 19.45%, meaning that right now, as of today, there are exactly 129 individual stocks in the S&P 500 that have outperformed it year to date. 25% of the companies in the S&P 500 have outperformed the index this year, year to date. So selecting the stock is not akin to finding a needle in a haystack. It's akin to finding a needle amongst 3 other strands of hay. That is what the stats show this year. Now, we've looked at this year alone, and you might make the argument that this year is special or unique, and typically it's more difficult for individual stock pickers. You'd be wrong again. In fact, 2023 was an unusually difficult year for stock pickers, far more difficult than most years in the market for individual stock pickers. Let's take a look at the data. Here's a table by year that shows the percentage of stocks outperforming the S&P 500 index. So the percentage of stocks in the index that have outperformed the overall index. In 2023, it was only 1/4, 25%. In 2022, it was 57%. The majority of stocks in the index outperformed the index because the biggest weighted ones, companies like Tesla, big tech, actually underperformed. So investing in basically any other company, in fact, over half of the stocks in the index, you outperform the index. In 2021, it was 48%.
So it's like what Punti says. If you want to try stock picking, don't just try to all in into one stock. Like imagine Punti all in into one stock. Like some guy go and all in into Alibaba. If it does well, then okay lah, you 2x, 3x. But it's the risk of losing that 100%. Maybe not 100% lah. You won't lose if it's a good company, right? But if valuations go down due to political risk, whatever risk, you lose like half of your portfolio money. Whenever I go for events, right, some people will always come up to me and say, "Oh, Kevin, I invested 100% into Tesla." I think like 2 years ago for me, I would say, "Hey, good for you, go invest more." But now for me, I've seen a lot more things already. I would tell them like don't all in into Tesla, because like let's say if Tesla does well, you can 5x, 10x your money. But what are the chances of it doing so well that it can give you this kind of crazy returns, right? Because you must remember, like for Tesla that did so well in 2020, it was just because no one discovered the stock back then. Then suddenly, everyone is covering it. All the YouTubers, all the fund managers suddenly are interested. Even for right now, they are still interested lah. There was a Tesla Con event in Singapore lah. The con means conference lah. From 20 years old to 30 years old, okay lah, you can actually make back that money. But are you willing to lose out on the entire 10 years just betting on that one stock? Like, why not just diversify a bit, get a bit lower returns, but at least you'll get a much higher percentage of winning lah. There's like, so we see Bunti's portfolio, it's only that 2-3 stocks that are red. Everything is green. I don't know how to put it. The word is like, it's very dumb lah.
Hey, this one I disagree. My portfolio also 2-3 stocks red, but overall still red because of allocation. But
Yeah,
anyway,
that's why
I
you
get what
didn't
you mean.
diversify enough, right?
Yeah, I get what you mean. So, Mei Tuan, you got any concluding thoughts? So this is a lost cause, is it? You're just gonna leave in your portfolio and just let it normally die and hope for if it comes back, it comes back. If it doesn't, it doesn't.
Yeah.
Okay, interesting.
I'm curious about this let it die naturally phenomenon, because at what point, right, do we is it because we neglected a certain stock, right? Like in my case, it was C Limited lah. So I didn't neglect it, but I saw the plunge, right? And then beyond a certain price point, I think to myself, yeah, heck it lah. You sell now, only get back a few $1,000s, then what's the point? Like you lock in the loss and then there's no upside if it should bounce back. Of course, it never did lah. It keep bouncing lower and lower. So yeah, so it's human psychology. I think sometimes we just like, okay lor, maybe one fine day it will go all the way up. But we all logically knows that for the stock to go back up, right, it got to like how many bagger? 5 bagger from this point, the current price. Then I will get back to the same price that I bought in. So it's like it's very illogical that it will do that. But yet we still like, okay, never mind, just leave it there. It may get back. So what's the chances of that happening? It's like super low, but it's just too painful. It's like 已经烂了, so just leave it lor. If you go and chop it off, then you forever lose your limb. But maybe 烂 already, it will recover on its own. This is a weird psychology. I don't know why we are like that, but I wonder how many people.
It's a sunk cost fallacy, right? Is it not?
Yeah. I don't know whether it fits perfectly into the sunk cost fallacy, but there is a certain point, right? A critical point where it drops beyond that point, right? You're like, screw it. It's not going to make any big difference. So we rationalize ourselves and then we just leave the thing there. I think a lot of investors do that.
Do share with us your experience down below as well on whether you have such stock picks and what was your thought process. And we'll see you guys in the next video. Goodbye.